In this video, I'm going to go over 3 scenarios which cover the main intercompany and consolidation issues. In the first scenario, the parent charges the subsidiary for marketing services. The parent company raises a billing for $25,000 and this needs a matching payable in the subsidiary. And then we need to sort out the eliminations and run the consolidation. Here's the billing raised in the parent entity, with the subsidiary as the customer, with a revenue account of service revenue. To create the payable in the subsidiary, we go to Intercompany Processes. You choose the expense account and click the button. If you go to Payables, you can open the newly created payable, which has the parent as the vendor. If you post the payable, you can see the results of the postings in a report we've created. The accounts receivable have been impacted in the parent, and in the subsidiary it's the accounts payable. Now we need to do some consolidation processing. Choose the year and period, and then click Make Intercompany Corrections. If we post the journals that have been created, we can see the effect on the report. The accounts receivable balances have been transferred to the intercompany account receivable, and similar with the accounts payable. Next, we run Make Elimination Journals, post the journals and see the effect in the report. The revenue and expense balances have been cleared. Finally, we run Make Consolidation Journals. And we can see the revenue and expenses have been correctly eliminated. In this scenario, the parent receives an invoice for rent plus maintenance. $2,500 should be apportioned to subsidiary B, and $1,500 plus the maintenance to subsidiary C. The rent demand is added as a payable in the normal way. But to apportion the rent, we need billings in the parent and matching payables in the subsidiaries. And then we need to sort out the eliminations and consolidation. So here is the payable for the rent demand. The vendor is Alpha Properties, and the billing lines go to rent and facilities expenses. If we go to Intercompany Processes, the subsidiaries that can be recharged are displayed. We have to match the expense accounts to revenue accounts for the billings in the parent, and the amount to be apportioned to the subsidiary. We do the same thing for subsidiary C, and then click Process Intercompany Payables. If we look at the payables, you can see there are 2 additional payables for the subsidiaries which need posting. And there are 2 additional billings which also need posting. We can see the results in the report. The parent has both accounts receivable and payable postings, but the subsidiaries have payable only. Now we do the consolidation processing. First make the corrections, and after posting the journal entries, you can see the results in the report. The account receivable balances are moved to the intercompany account receivable, and the same with the account payable, leaving the balance owed to Alpha Properties. Now we make the eliminations and post the journal entries. And in the report you can see the intercompany revenue and expenses have been eliminated. Finally, we run the consolidation. Post the journals, and we can see the consolidation companies has the correct amounts in the accounts receivable, in the rent and rates, and in the facilities expense. And you can also see this in the consolidation company trial balance. In this scenario, subsidiary B makes a $25,000 dividend payment to the parent. A dividend journal is raised in the subsidiary. but this needs a matching journal in the parent. Because these are intercompany dividends, they should be eliminated, leaving no effect in the consolidated company. So here is the dividend journal in subsidiary B. The important thing to note is that the journal line items must have the account field populated. If we choose the intercompany process, you have to choose which GL account will be used in the matching journal. A journal has been created in the parent, and this must be posted. The report shows the effect of these journals, and then we do the consolidation processing. First, we make the intercompany corrections, but as no corrections are required, no additional journals are created. Next, the elimination, which creates the journals which we need to post, and then make the consolidation journals and post them. You can see that in the consolidated company, the intercompany dividends have no effect.